Imagine a single decision, made almost casually, that could steal 2 decades of your financial future. A decision that costs you not just thousands, but potentially hundreds of thousands of dollars in lost wealth. It's a decision most Americans make every single month, paying only the minimum on their credit card debt. By the end of this video, you'll understand exactly how minimum payments are a meticulously designed financial trap, often stretching repayment over 20 years or more. You'll see the devastating true cost in both dollars and lost opportunity, and most importantly, you'll learn the precise strategies to escape this cycle and reclaim your financial freedom. The illusion begins with the statement on your bill, minimum payment due. It feels manageable, a small hurdle you can easily clear. But this seemingly innocuous number, often just 1% to 3% of your outstanding balance plus interest, is the credit card company's most profitable secret. It's engineered to keep you in debt for as long as possible, maximizing the interest they collect. They want you to feel a sense of relief, a sense of having handled your debt, while subtly ensuring you remain a consistent revenue stream for years. Let's illustrate the true cost with a common scenario. Suppose you have a $5,000 credit card balance at a typical 20% annual percentage rate, APR. If your card issuer calculates the minimum payment as 2% of the outstanding balance, or $25, whichever is greater, your first minimum payment would be $100. Sounds reasonable, right? However, that $100 payment is immediately eaten by interest. At a 20% APR, your monthly interest on $5,000 is approximately $83.33. That means a mere $16.67 of your payment actually reduces your principal. The following month, your balance is only slightly lower, and the interest calculation starts almost from scratch. This slow principal reduction is the core of the trap. If you consistently pay only the minimum on that $5,000 debt at 20% APR, it won't take a few months or even a few years to pay off. It will take approximately 19 years and 3 months to fully eliminate the debt. And the cost? You will have paid an astonishing $5,595 in interest alone, effectively paying more than double your original purchase price. That $5,000 item actually cost you over $10,500. But here's where it gets truly insidious: the opportunity cost. This is the hidden trap, the wealth you didn't build because that money was siphoned off by high-interest debt. Imagine if, instead of paying over $5,500 in credit card interest, you had invested that same amount into a diversified S&P 500 index fund. The S&P 500 has historically returned an average of about 10% annually over long periods. If you had taken the $250 per month that a slightly accelerated payment plan might free up, or even just the average interest you'd pay, and instead invested it for those same 19 years, the outcome is staggering. A consistent $250 monthly contribution, compounded at 10% annually, would grow to over $160,000. That's $160,000 in your investment account versus $5,595 in interest paid to the credit card company. This isn't just theoretical. This is the real-world difference between someone struggling to get by and someone building significant wealth. The 20-year trap isn't just about debt, it's about the lost potential for retirement savings, a down payment on a home, or funding your children's education. It's about denying yourself the power of compound interest, which Albert Einstein famously called the eighth wonder of the world. To escape this trap, you need a proactive strategy. The first step is to stop making minimum payments immediately. Find every extra dollar you can. This starts with a ruthless budget. Track every penny for a month. Identify non-essential spending, the daily coffee, the streaming services you don't use, impulse purchases. Even small cuts add up significantly. Once you've found extra cash, choose a debt repayment strategy. The debt snowball method focuses on psychological wins. You list all your debts from smallest balance to largest. Pay the minimum on everything except the smallest debt, on which you throw every extra dollar. Once that smallest debt is gone, you take the money you were paying on it and add it to the payment of the next smallest debt. This creates a snowball effect, building momentum as debts are paid off faster and faster. Alternatively, the debt avalanche method is mathematically superior. List your debts from highest interest rate to lowest. Pay the minimum on all but the debt with the highest APR, on which you focus all your extra funds. This method saves you the most money and interest over time. While it might lack the immediate gratification of the snowball, it's the most efficient path to becoming debt-free. Consider debt consolidation if you have good credit. A personal loan with a lower fixed interest rate can combine multiple high APR credit card balances into one manageable payment. Be cautious, however, and ensure the new loan's interest rate is genuinely lower and that you don't simply rack up new credit card debt after consolidating. A balance transfer credit card can also offer a 0% introductory APR for 12 to 18 months. This provides a crucial window to aggressively pay down your principal without accruing new interest. Just be aware of balance transfer fees, typically 3 to 5%, and be absolutely committed to paying off the balance before the promotional period ends and the high standard APR kicks in. Building a financial firewall is crucial for preventing future debt. Start by establishing an emergency fund. Aim for at least $1,000 initially, then work towards 3 to 6 months' worth of essential living expenses. This fund, held in a high-yield savings account, HYSA, acts as a buffer against unexpected expenses, a car repair, a medical bill, a job loss, preventing you from turning to high-interest credit cards out of necessity. Understand your FICO score and how credit utilization impacts it. Keeping your credit card balances below 30% of your available credit limits is vital for maintaining a healthy score. A strong FICO score not only helps you secure better rates on future loans but also signals financial responsibility, opening doors to better financial products and opportunities. Finally, prioritize saving and investing, even while aggressively paying down debt. If your employer offers a 401k match, contribute at least enough to get the full match. That's free money, an instant 50% or 100% return on your investment, that far outweighs even high credit card interest in value. Once high interest debt is gone, supercharge your contributions to your 401k or Roth IRA. Every dollar saved today is many more dollars tomorrow thanks to compounding. The true cost of minimum payments isn't just the thousands of dollars in interest you hand over, it's the six-figure fortune you sacrifice, the decades of financial freedom you postpone, and the peace of mind you forfeit. It's the 20-year trap that keeps you on a treadmill, running hard but never truly moving forward. Don't let minimum payments dictate your financial destiny. Take control, implement a plan, and reclaim your future. For more insights on building lasting wealth, watch our next video on the power of compound interest, your path to financial freedom. The true cost of minimum payments isn't just dollars, it's the future you could have built, the financial freedom you sacrificed, and the decades you spent running on a treadmill designed by lenders. It's the missed opportunity to invest in your 401k or Roth IRA, to build a substantial down payment for a home, or to simply live without the constant weight of debt. Understanding this trap is the first step. Taking decisive action to break free is the ultimate empowerment. If you're ready to take control of your spending and build a solid financial foundation, watch our next video on the ultimate guide to building a debt-free budget. Remember, your financial future is not determined by your past choices, but by the empowered decisions you make today.